believe we stopped. We didn't do primary and secondary markets. I'm to assume that that's correct, unless someone says otherwise. So, so primary markets are when a security is issued for the first time. And so the most common primary market transaction is an initial public offering. It's also one of the more kind of glitzy and glamorous transactions in equity space. Initial public offerings tend to also be very lucrative for investment banks. They typically have a lot of interest from potential investors who want to get access to a new company that's coming to the equity markets for the first time. And oftentimes, most of the shares are held by investors who had invested on the private equity side, so like venture capital. So if you think about Uber as an example, Uber just didn't like create a business; they had to get investors, since they got private equity venture capital investors to invest in the startup. And then once it gained enough momentum, grew its business enough, they actually were able to come to market and say, okay, all of you venture capital investors who invested with us many, many years ago without any real guarantee that this business would succeed, you get to participate and sell some of your shares in the IPO to unleash some of your realize some of your returns. And usually it's a very large return, because something around, estimates I've heard are roughly 9 out of 10 venture capital investments are failures. So that means that the one that isn't a failure needs to have astronomical returns. It's a very risky thing to invest in a startup. The vast majority of startups fail. And so yes, those venture capitalists, they got, a 1,000% return on their original investment, but then they have 9 other investments that they lost the majority of their investment altogether. A seasoned equity offering, that is when a company who already has publicly traded shares decides to issue more shares. This is not always looked at favorably from investors. Existing shareholders, once this occurs, their new stake in the company, even though they had not sold or bought any shares, their stake in the company after the issuance of these seasoned equity offering units has been diminished. They have been diluted, is the term that's used. So it's not always looked on favorably. Methods to sell securities in general. And this is not just for equities, it can be for bonds as well. Private placement, there are private placement bonds. An underwritten offering, that's when an investment bank essentially comes in and provides some support. And so the lead left book runner for IPOs is what it's called, or for bond offerings. The lead investment bank on the deal will actually provide their own capital to support the price of the offering. So I believe it was Morgan Stanley that did Facebook. I don't know if anyone in the class followed what happened when Facebook did their IPO, but it actually was a bit of a failure. And Morgan Stanley was buying Facebook shares to support the price on the first day of public trading, like they promised to do, all the way up to the limit. They have a cap on how much they can buy based on their own risk management policies. And rumor was that the the lead deal maker at Morgan Stanley, essentially made a comment of, we have more Facebook than we will ever know what to do with. Because they, in the middle of the day, in the middle of the trading day, Risk came in and said, okay, you have to stop buying Facebook. And the price fell. In the end, it recovered quite a bit. That was mostly a lot of concerns over, well, how does Facebook actually make money? And fast forward, 10 years now, 9-10 years. And now we know quite well how Facebook makes their money. Shelf registration. The issuer can essentially register register their filings with the SEC, register their securities, do all the filings and paperwork and all the due diligence, and essentially they can wait until an opportune time to actually sell the securities. This can be for equity shares as well as bonds. They're, so to speak, sitting on the shelf ready to be sold. Direct listing. Did anyone follow the direct listing of Spotify a few years ago? You can use the raise hand button or however you want to respond. Did anyone follow how that unfolded? No one? So first of all, everyone knows where Spotify is headquartered, right? Does anyone know, actually? Other than me, obviously I know. So Spotify is headquartered in Sweden. And this was a big deal because they decided to do what's called a direct listing, which means that mostly existing shareholders, which were predominantly employees of the company, just decided that they would all pitch in and everyone would essentially sell their shares in the market, and it would just get listed in the market exchanges and it would just get sold to whoever wants to buy it, which is different from an IPO process. An IPO process is the shares are sold in the primary market, and then those owners of the shares have the discretion, predominantly the broker dealers, have the discretion to then sell them out to other investors. That's much more expensive. So Spotify said, well, we're just going to have our shares listed on the exchanges. It's just like flipping a switch. And I can't remember who the lead investment bank was for it, but there was only really one because you don't have any risk. They just listed the shares. And so on the day that they actually did this, the investment bank, essentially, a silly way to describe it, flipped the switch to turn on trading for Spotify. And of course, the New York Stock Exchange was very excited. And so they put a flag up. They usually have 3 American flags at the New York Stock Exchange. And so they, of course, put up the flag of Switzerland. It took them about an hour and a half to realize that they were supposed to have the Swedish flag up there. But that's a direct listing. It's not very common. It's not very common. And those of you that think I'm being silly, they're actually, you can probably Google it and get lots of people who screen grabbed photos that the New York Stock Exchange posted to Twitter before they took them down. It was a pretty big glaring mistake. It's like when at the Olympics they queue up the wrong national anthem for the gold medal winners. Any questions before we talk a little bit about stock market indexes? Okay. So let me, first of all, go ahead and disclose, I do not like the Dow Jones. It has nothing to do with, well, is it because I don't like the original publisher of the Wall Street Journal? Do I have something against Charles Dow? No, it's just the way that it's calculated. The Dow Jones Industrial Average is literally an average. It just has a different divisor, is what it's called. It is literally an average of 30 stocks. And it's not that I don't think it has any use. I think it has use. I think it's correlated, but I feel like the market hype about, well, the Dow, and people are like, oh, did you see the stock markets? They were up 1,300. Oh, you're talking about the Dow Jones. Okay. And it's the point, also like the points, it's the points change. It's not the percentage point change. It's how many points did the average change. And so that's why I don't like the Dow Jones. People get really sucked into it. It can also be overtly influenced by the highest priced stocks in there. As an example, if Berkshire Hathaway's A shares were in there in the Dow Jones Industrial Average, then it would just be the Berkshire Industrial Average, the Dow Jones Berkshire Index, because it would be completely overwhelmed by the price of Berkshire Hathaway. So it's a price-weighted index. And all the Dow Jones indexes are. And it's not, it actually was an interesting phenomenon in history. Charles Dow he was one of the lead publishers that published the Wall Street Journal, and he wrote a column. And every time he wrote his column, he would update his Dow Jones Industrial Dow Jones Industrial Average. They actually just called it the Dow Average because he wrote it in his column. And he literally picked the 30 stocks that he liked to follow to give him a sense for the direction of the overall market. And he took a simple average of their prices. And if you're wondering how long ago that was, it was the late 19th century. And Charles Dow wrote his column, I think, about once a month. So imagine only getting an update on the stock markets once a month. Fast forward a few years, in the middle of the stock market crash and the ensuing volatile days of the years ahead, or years after that, I should say, they usually had one person at any given point in time that would calculate the Dow Jones average at the end of each business day, and they literally had to do it reading the physical ticker tape. And sometimes during the lunch break, the stock traders on the floor of the exchange would all huddle around the person calculating it, and he would literally cut his hands pulling the ticker tape, trying to find the 30 share prices on the ticker tape, physical ticker tape, and would calculate it by hand and then report to everyone what the Dow index, what the Dow average was doing. We've come a long way since then, to where if we don't have an update every second, even intrasecond, we feel like something's wrong. Just a little aside, a little history tangent there. So most people who follow equity markets prefer market cap weighted. They have their own set of problems, but they tend to give a better sense of the direction of stocks, of the equity markets. They are going to be overtly influenced by large market cap companies. And so think about the S&P 500. How much of that movement of the S&P 500 today is driven by Alphabet, Amazon, Apple, Netflix, Google, Microsoft? They are overwhelmingly driving the changes in the S&P 500 because they are such enormous market cap companies. Russell has several different variations. There's also some in the S&P. There's an S&P 400, the mid cap. So you take out the 100 largest to give a sense for what's the remaining 400 that are a lot smaller doing. NASDAQ is another one. They're all market cap weighted. So let's go through an example. Now this one, I do not calculate the divisor. You don't have to calculate the divisor. You can if you want to, but you don't have to calculate it. And I don't think it's useful for me to say, oh, well, what's the divisor of the stock index? I may actually have put that on if I do put it on a quiz, it's just a way for me to give you a sense of, okay, calculating a divisor, but you don't have to. So calculate a price-weighted index from 3 stocks below with an initial value of 100. So initial value means that 25, 30, and 2.5, that's the initial date. These are the changes over the day. Increases to 28, falls to 28, falls to 2.2. So 25 plus 30 plus 2.5, 25 plus 30 over 2.5, that's the initial value times 100. There, you're done. So the divisor in this case would be 25 plus 30 plus 2.5 divided by 100. Would be the divisor. What's the index after this trading activity occurs? So 25 price increases from 25 to 28, so you have 28. Price decreases from 30 to 28, so 30 to 28. Price falls from 2.5 to 2.2, 2.5 to 2.2. You have the initial, you have this little, you have the initial prices down here in the denominator. You multiply by the initial index value and you get 101.22. So that's a price-weighted index. That's essentially what the Dow Jones Industrial Average does. So, it might actually, what's wrong with that? What's wrong with, hang on. I always have this issue. When I use the drawing features, okay. For some reason, when I use the annotations on presentation mode, it messes it up. I can't see my cursor after a minute. Where did the initial value of 100 come from? From me. I told you what it was. An initial value of 100. I give that to you. You have to start from the value somewhere. So if it was 120, you'd multiply by 120 exactly. You would change. At the risk of having the same problem again, you would change the 100 right here to 120. Absolutely. So what happens? We keep the initial value of 100 on the formation date, the index formation date, 25, 30, and 2.5. But now instead of price weighted, we're going to do market cap weighted. The market cap weighted, the first equation is the initial value. That's just showing you what goes where. But then when you plug in for the end of trading, the $25 share price increases to 28. The $30 share price decreases to 28. The $2.5 share price decreases to 2.2. We have 20 million, 30 million, and 200 million shares trading. Look at that difference. We go back up, a 1.2% increase on the day for the price weighted, the same companies, a 3.2 roughly percent decrease in the market cap weighted index. This is why, not too infrequently, you will see days where the Dow Jones has moved in a different direction than the S&P and the NASDAQ. Now, you can have days where the S&P and the NASDAQ move in different directions as well. The most common is when the Dow Jones is moving in a different direction than the S&P and the NASDAQ. The NASDAQ is much more tech heavy, so if tech is really having a tough day, but everyone else is having a really good day, it's possible that the S&P is positive and tech is negative, or vice versa. Tech is still a very large part, a large weight of the S&P 500, so it is a lot less common for the S&P 500 and the NASDAQ to move in different directions. All right, here's a sample problem. And I want you to take, I'm going to give you a couple, 3 minutes, I think. I'll set a timer. I'd like for you to start working on this to see if you can do it on your own. And here I actually have you calculate the divisor as of the 16th of February and the 18th of February. They will be different because you are replacing CHO is going to come out of the index and DIY is going to go into the index. So only do the price weighted because the market cap weighted I'm going to do in front of you. But take a few minutes. I want you to calculate the price weighted index divisor AAC, BZF, and CHO. It's equal to 550 at the close of trading on 16th of February. 75, 150, and 10. So calculate the divisor. Calculate the value of the index at close of trading on the 17th. And then after that close of trading on the 17th, you will replace CHO with DIY and get a new divisor going forward. So let's just start by calculating the divisor. Go ahead. If anyone's having if anyone has questions, you're more than welcome to ask in the chat or by unmuting your line. All right, does anyone want to share what they got for the divisor on 16th of February, 2021? All right, so I see 0.62, and then on February 18th, it would be 0.598. How confident are you that those are correct? I've worked these before, but not at all. I don't know. I don't remember if that's correct or not. Did anyone else get the same numbers? All right, so 550 equal to 75 plus 150 plus 10 divided by the divisor. Rearrange this. Correct? Divided by 550. I'm just double checking it. This is what I got. This one is, it goes on 2727 forever. So at some point you have to stop. So you divide the price by that, you get the index value. So what's the index value on day 2? Or the, what is it, February 19th? So 17th, sorry. Substitute in. Or 27273, just to abbreviate it. 80 plus 140 plus 12 is 232 divided by 0.42723. Equals 542.98. Price weighted stock index has stocks AAC, BZF, and CHO in it. It is at 550 on 16th of February. CHO is replaced at the end of trading day on 17th of February, 2021. So the way that you do this replacement is you calculate it at the end of the trading day as if it still has CHO in it. Now, this is actually the tricky part. This is why we replace CHO, that's 10, or 12, excuse me, with 107. Our new divisor going forward after we replace has to meet this as well. When we replace CHO, we remove CHO and we replace it with DIY. The new index needs to be the same. The new divisor needs to give us the same index value. Now we have a new algebra problem. $542.98. $80 plus 140 plus 107 divided by 542.98. Now our new divisor is equal to 0.6022. So when a company gets added to an index and replaces another company, this is how they do it. It's replaced after the trading day when we know what the new close of trading day index value is with all the old components. Remove the component that's being taken out, replace it with a new component, figure out the new divisor. Now we have a new divisor. Bodie, Kane, and Marcus spend a lot of time in their textbook, more than I think is necessary, talking about, well, what's the impact of the divisor if you replace a $30 per share stock with a $70 per share stock. They also need to create new divisors when there are stock splits. Whether it's a reverse split or a regular split. And so, do we have the values when the stock is split? Yes. When the stock is split 2 for 1, you just divide the price by 2. So it's the old divisor is the old price, and then now the stock is split. The new price, you replace it with the new price, which is 1/2 of the old price. So yes, you have the value of that one share, just that one stock. Here we are. It has been as low as 0.147 in September of 2019. The original divisor for the Dow Jones, like I said, was 30. All right, now, if you'll indulge me, what's the market cap weighted? What if we do this market cap weighted? So I'm not going to bother with calculating a divisor. Can't see the number of shares. There we go. I am just going to calculate the index based on market cap changes. So Let's do that. Index. Seventeenth Feb. $5.50 times let's see. I'm going to do these in thousands. That's thousands of shares. Or sorry, millions of shares. Not watching my units. Millions of shares. AAC is $75 as 1 million shares on February 16th. That's here. BZF is 150, has 800,000 shares, so 0.8 million. There. $10 per share for CHO, 50 million. And then up in the numerator, I just simply update the prices. So 75 to 80, 150 falls to 140, 10 goes up to 12. $80 plus $112 plus, I think that's 600. That's 500. $120. 75. Ooh. What was the price? 542.98. It fell by 7 points. That's quite a big difference. CHO is a rather large company. A 20% increase on this size of a company had a much bigger impact on a market cap weighted index. So how do we calculate the index for the 18th? Well, it's 626.76. We're replacing CHO, we're removing that and adding DIY. So what we have to do, first of all of the data for the '17th needs to be in the denominator. So rather than CHO at $12, we put in DIY at 107. Has 8 million shares. goes to 82. This goes to 135. This goes to 104. So we have all the data for the 18th in the numerator, the 17th in the denominator, and now all we have to do is our calculator tricks. All right. I believe so. Oh, minus 56. Done. Not quite done. Now we're done. Now these are very bizarre examples because I've given you 3 stocks, 3 companies' equity shares. But the really fascinating part, I tried to devise these, especially in lecture, to show you the difference of using a price-weighted index declined by 7 points versus a market cap weighted increased by 77 points. Now these are extremes. But this is typically why most academics and most practitioners really aren't the biggest fans of the Dow Jones. Just has to do with the fact that it's an imperfect measure. They're all imperfect measures. And you can't just throw away the Dow Jones. Like I said, the data for the Dow Jones goes back all the way to the late 19th century. So, questions about market indexes, equity market indexes specifically? Okay. All right, let's talk about ADRs, ECNs, dark pools, and other. ADRs, American Depository Receipts. These are equity securities issued in the US, denominated in US dollars, but they actually are claims on shares that are held on deposit in an account on the exchange where that company's shares trade. that seems a little bit difficult to comprehend. So let's take Royal Dutch Shell. Shell, oil company. You can invest on U.S. exchanges in Royal Dutch Shell RDS shares. They have an RDS-A and they have an RDS-B. But they're both American depository receipts. The primary exchange, I believe, is Amsterdam. So you're buying these certificates that just are claims on, each certificate is a claim for some fraction that could be less than or greater than 1 of a share being held on deposit at the exchange in Amsterdam. And okay, Nokia, yeah, same thing. It's a way for shareholders in other currency zones to participate in ownership rights of companies whose primary exchanges that their shares trade in is somewhere else. There are also some very interesting things that have come up regarding network exchanges in the same currency zone. Electronic communications networks. Essentially crossing exchanges. So it allows for transactions directly between broker-dealers and institutional investors, as opposed to having to have them routed through the exchange. Send this to our trader on the exchange, on the floor of the exchange. These were a big deal when they first came about. Now, essentially, all exchanges have these, especially equity market exchanges. Part of these networks, and the textbook does a good job of explaining this in more detail. So I do highly recommend that you follow up with it there. But they're called dark pools of liquidity. So even up until the late 90s and early 2000s, the stock markets, the New York Stock Exchange in particular, had a lot of floor traders and a lot of specialists. And a market specialist is a specialist who specializes in trading in specific company shares. So GE, and it's usually they specialize in a few, but they can only handle so much. They're people after all. Now, these specialists would also prioritize block trades. So large broker-dealers that were trading on behalf of lots of clients would route their trades to the floor of the exchange, and hundreds or thousands of orders would come in for GE, all buy. The broker-dealer would simply, let's just put them all together in one order, and the market specialist who handles GE will gladly take our order for 50,000 shares. Those are block trades. It's a huge block of shares being sold. And they were usually on multiples of, I think it was 10,000 was the typical block trade. 10,000, 20,000, 30,000, 40,000. On the downside is that you can see which broker-dealer is doing it. You can probably work out, well, who's a big client of them that usually routes big trades through Morgan Stanley or through Salomon Brothers, when they used to be Salomon Brothers. So broker-dealers started to do these off-exchange transactions. And some of them have different rules. For instance, it might be, well, you enter your order, and at the end of the hour, if there's a matched order, you want to buy, they want to sell, and it's for about the same amount, it'll just transact at whatever the closing price is at the top of the hour, and we will broker that transaction. And so it took them off of the exchange. But it allows for huge orders to go through without moving the market, because they simply agree through this brokered transaction, through a dark pool transaction, and typically done electronically, to abide by the rules of what the market pricing would be, and would transact assuming that there are sufficient opposing orders running through these dark pools. Now, of course, there are always different avenues in which organizations that work in financial services and in financial markets industries can make money, and high-frequency traders actually essentially get access to the order flow in electronic communications networks and through dark pools. They still don't see, any identifying information of the parties transacting there. But by doing so, they can actually, fractions of a second faster, using high-speed connections, using high-powered computers, do very, very large but quick transactions repeatedly throughout the course of days, weeks, months, to try and earn a profit by using that order flow, give them an indication as to what some very short-term price changes will be. So these are done by hedge funds. These are not done by the broker-dealers. That would be violation of law. But the broker-dealers were not violating law when they gave access to some information to high-frequency traders. The world of financial markets is, as you can probably tell, in a lot of instances, you can find many instances you can find where it's not necessarily doing right by everyone, acting within the rules. So we take the good with the bad. Let's see. I've got 7 o'clock. Let's talk quickly about market trading. Let me see how many more slides I have in this pack. Yeah, I'm going to try and get through some of this before we go to break. I think we can, I'm going to try and get through these. Bear with me. I'm going to try and get through these quickly, and then we'll go on a break. Okay, so market trading. Any questions about or comments about this? There's a lot of unsavory things that go on. And me just not admitting that, I think, does a disservice. And this is one that's gotten a lot of criticism and scrutiny over the years. So so long as you stay respectful, you're welcome to voice your opinion or your criticisms, as long as they, again, stay respectful. But any questions, comments about ADRs, ECNs, and dark pools? Okay. Market trading. So what are the different types of orders that you can have in the marketplace? These are, very broadly speaking, the main ones that you can have in financial markets for securities. A market order. The order just transacts at whatever the market's pricing at. And I'll get a little bit more into detail about that. A limit order. Transact only at a specific price or at a price that is more favorable. So if you're selling shares and you say, I want a limit order of 50, I will sell at 50 or higher. And that's what you'll get. And there might be some price improvements. Your average sales price might actually be 50.2, 50.20. That would be favorable to sell at a higher price. Limit order to buy at 50. Buy at 50 or below. Obviously, you wouldn't say no to that. There's a stop. And most places call it stop quote. Transact, buy or sell, if the market price crosses a certain point. So sell if the stock price hits 50, usually meaning it's falling. I want to make sure that I cut my losses. Buy if the price rises up to 50. I want to enter, if it starts to rise, I want to make sure I get in before it gets above 50. You can have a stop quote limit where you also say, okay, put in an order, but at a limit price. The last type of market order that we'll talk about is a trailing stop. Most commonly, this is as a percent. So let's consider a trailing stop loss. So you're in a sell with a trailing stop of 10%. So what happens is that your stop quote will only move up. If the stock price moves up, at the end of the day, what's a 10% loss? That's your new stop quote. If the price moves down, your stop quote doesn't move. But then if it moves up again, assuming it wasn't triggered, then you get a new trailing stop limit, stop quote. That's 10% below the new higher closing price. So trailing stop is a way for investors to continue to have some positive participation, but to provide a downside protection of exiting if it starts to fall, if the price starts to fall. Obviously, you can have a trailing stop buy order where the trailing stop will only move down. But then when the stock price moves up, that stop quote doesn't change. And if the price goes up to the stop quote, then you buy. Now, this is a graphic from the textbook. I noticed that this is called an order book. Does anyone see anything particularly off about this order book that Bodie, Kane, and Marcus have in here? Or rather, their publishers do. These are the bids. These are the asks. Bid price. The price at which the market is willing to buy the shares from the investors, the open market investors. So if the investor wants to sell, they have to sell it at these prices. Bear with me for a minute. Asking price. That's the price that the market makers are willing to sell at, so the broker-dealers. So if you want to buy, you have to buy at the asking price. There's a question that I think I missed in the chat. Can you place stop limits after hours or pre-market? No. Unless you have access to extended hours trading, which some platforms might offer that. No, those are usually large institutional investors and predominantly market makers. Does having different types of open orders in place have any impact on the market price? No, it doesn't. And in fact, if you look at the order book, these are all limit prices. These are all limit prices. So really quickly, I know everyone's just suspense is just thick in the air, I'm sure. There's a typo here. Pretty sure that's supposed to be 149.75. So, oh, whoops. Yeah, thought that spread was off. Yep, that sure is. And also look at the direction of the prices. So the bid, when you're trying to sell in the marketplace, you're going to have to look at the bid prices because that's where you're going to sell. And so look at the order of the bids, 147.75, then it jumps up to 149.74, then it moves down, down, down. That's why I'm pretty certain that that's supposed to be 149.75. And on top of that, look at the asking prices. If you want to buy in the market, you're going to have to buy at the asking price. That's what the market is asking that you pay. 149.76, which is 1 cent higher than 149.75. And as you go down the column, the price increases. So I replaced them here. I fixed it. Good. Let's say that you had a market order for 800 shares to sell 800 shares at the market price. What would your price be? What would your price be if your market order sell 800 shares? Would you be using the bid column or the ask column?
You'd be using the bid column, right?
You'd be using the bid column. Yeah.
Presumably you'd get 50 at 75 cents, 701 more at 74 cents, and the remainder at 73.
Yeah, exactly right. Multiple fills. Yeah, you'd be filling multiple bid orders with that market order. It's one market order, but the average price is weighted average 50 here, then 701 here, and then another 49 at shares at 149.73. So you have to calculate that out. It now becomes an an arithmetic problem. So you take that weighted average, and that's your new market price. It's going to be roughly 149.74, just a little bit higher. Because you've got 50 at 149.75 and 49 at 149.73. And that's what order books look like. Now for exchanges, you can actually see order books if you have access to the proper platforms, proper technology. You can see it much more clearly if you're looking at a specific bond. And so the same thing happens if you do a market purchase. You buy at the ask. So with 800, then it would be 500 at 149.76, and then 300 at 149.77. So this makes more sense to me. There are lots of different things that happen in the marketplace. Just to give you a sense for some of the things that do happen. If a large client has a large position that they want to try and liquidate, it would flood the market if they put it all on at once. So they can do different things. They can try run it through dark pools. Maybe that works, maybe that doesn't. They can try doing what's called an iceberg order, where they essentially say, well, here's how much I want to sell. I want to sell 50,000 shares. If you put all 50,000 shares on the marketplace, the market's going to see that and they're going to freak out, and then they're going to start essentially putting the price lower. That's a huge sell order that's coming down. What's going on? So people will start selling out because they see that order. But what if you just put 50,000? Let's just put 200 to sell right now. Limit order, a little bit off market, just by a penny or two, a cent or two. Once that fills, put another 200 on the market. Piecemeal. And you also change the size of the amount you're putting on the market based on the typical average volume at that time of day. That way you spread it out over the day, also trying to transact during the most liquid times of the day. That takes work. Are bonds a lot more complicated than stocks, or is it just math? The bonds are a little bit more work than stocks until we start to actually value a company, although that seems to be a lot less important these days. Bonds do have complications that stocks do not. First of all, bonds mature, so you have to be looking for a specific bond issuance. If you are unfamiliar with that, just try and look up Ford bonds and just see how many different bonds Ford has issued that are still in existence today. My colleague has a joke. Ford, if you look at their capital structure, they're actually an auto lender that also happens to make cars. And if you look at their capital structure, that kind of makes sense. All right, margin and short selling. Margin accounts. Any questions before we talk about margin and short selling? Any other questions, I should say? There have been some good questions here about what goes on in markets. And this is true not just for stocks, it's also true for bonds. It's true for anywhere where there's a public exchange where the order book is available to be seen by market participants. Okay, let's go ahead and take our break now. We are running a bit late. I don't know if we'll get through mutual funds. So let's take a break, come back at 7:25, okay? I'll pause the recording too, so if I forget, please remind me to start the recording up again. All right, everyone, I have about 7:26, so I'm going to go ahead and start back up here. All right. Always takes me a minute because I have to get my chat window in the right spot. Okay, so we'll see if we can get into mutual funds at some point this evening. It should be a shorter discussion. It's a much shorter slide deck, even though it says it's a full chapter. It's a lot shorter. So I do want to talk about margin and short selling in the current environment, and with the fact that essentially anyone, almost anyone, can get access to margin and short selling. I think it's important to understand not only the benefits, because that's usually what people think of, but also the significant risks tied to this. So margin accounts. you have to essentially apply with your broker and at most large brokers to get access to margin. And a margin is essentially using a loan, using borrowed money from the broker to purchase more assets than you actually deposited in value in cash and securities when you opened your account. If you don't have enough cash in your account, that's okay. Just buy on margin. It is a loan. That loan is going to have interest. That loan is also going to require a certain amount of collateral. And if you don't have enough sufficient collateral, you will get a margin call. That will either require you to post more collateral or to sell assets in your account. Leverage is a double-edged sword. When the market moves in the investor's favor, it works out extremely well. When the market moves against the investor, it is disastrous. And I don't want to gloss over the fact that it can be disastrous to the point where individual investors succumb to very dire decisions. And this might be becoming a little too serious for people who were expecting talk about margin and leverage in this class, but that's a real thing that does occur when manias occur. And it's not just, one person here or there. It comes in waves, and there are, during periods of significant financial turmoil, it increases. It actually is part of the data you actually see, as that it is tragic. Lots of tragedies occur. So that is part of what part of the reason why I'm critical of platforms like Robinhood is because they make it too easy to get access to leverage. And I think that is dangerous. Not for the businesses or companies, for the people that are using those platforms. So let's talk about margin. Let's talk about the actual feature of it. How does it work? Initial margin, it's the amount, the limit of how much you can actually borrow given the value of your account, the market value of your account. Now, typically, it'll vary by broker-dealer. It might vary by how much you have in your account. For individual investors, for institutional investors, it will vary based on the standing of the client. Are they very creditworthy? Do they have a long-established relationship? Do we know something about their business that makes them a lot less risky? For most typical retail broker-dealer accounts, retail brokerage accounts, that's going to be 50%. You need to keep 50% in your equity at all times. Of 50% of account equity at the initial margin. Now, when you do take out a margin loan, which is very seamless, you just simply buy more securities than you have cash to purchase. There's a comment in the chat, and I hope that's not true. So you can borrow up to however much gets you to 50% account equity. Assets minus loan divided by its loan. Now, as market prices change, there's usually a maintenance margin. If your margin level, your leverage, goes below a certain amount, your broker will call you and say you need to post collateral to deposit more cash, or you need to sell assets in your account. Now, in the textbook, there is an example 3.1 and 3.2. An investor has $6,000 of cash in a margin account and purchases, and that's all they have in their account, They purchased $10,000 worth of stock. That's $100 per share. So that's a $4,000 margin loan. What's the initial percent margin of the account? What happens if the stock price falls to 70? At what price would the account holder be called, would receive a margin call to post more collateral with a 30% maintenance margin? So here we go. Here's the margin calculation. Equity in account divided by the value of the stock. More broadly, I think that would be value of the portfolio, market value of the portfolio, the account. So it's $10,000 the value, loan is $4,000, equity is $6,000. 6,000 divided by 10,000, that's 60%. Pretty straightforward. Stock price falls to 70, it's $70 per share now. There are 100 shares in there. That's $7,000. The equity in the account, loan remains $4,000. The loss in value comes out of the equity value in the account. Doesn't matter what happens, the account owner, the account holder is going to have to pay that $4,000 plus interest to the broker. They have borrowed money from the broker, and they're going to have to pay it back. The margin in the account has gone down to 43%. Have not yet hit a margin call. What's the price at which a margin call would occur with a 30% margin? Well, all you do is you figure out what's the equity in the account. So you take the value, the only thing is that one equity position in the account, which is 100 shares times the price, minus the loan balance, $4,000, divided by total assets in the account, 100 shares times the price. When that hits 30% or 0.3, that's when they get a margin call. So here are the steps to actually calculate that out. 57.14. Now keep in mind, at 57.14, the equity in the account is now $1,714. The original equity in the account was $6,000. This investor has lost 71% of their investment. The stock price has fallen about 43%. Still a significant drop. That's the power of leverage. That's the risk of leverage. And so we kind of talked about it kind of jokingly earlier on in the semester, short sellers in the market, especially hedge funds, which do a lot of short selling activity. That's why all it takes is one or two really bad trades for a specialist short seller, hedge fund, and they're out of business. They might be using more leverage than this 50%. What about a short selling example? Any questions about margin and margin loans? So you have to have a margin account if you want to do short selling as well. Because short selling is also a loan. It's just that rather than being lent cash, the investor was lent shares. Shares that were sitting in the broker-dealer, in other brokerage accounts, in other margin accounts. Now, keep in mind, and the textbook goes through this, I've said it before and I'll repeat it again. If an investor shorts shares of common equity shares of a company that pay dividends, if dividends are paid during the period in which this investor has shorted the stock, this investor has to pay those dividends to the accounts that those shares came from. Those account owners, those account holders bought those shares and have agreed to allow the broker to lend those shares to other investors through the margin agreement for short selling activity. But that doesn't mean that they would forego the dividend payments. The short seller has to pay those. Part of the aspect of margin accounts, it's in the agreements, are very long and detailed, written by teams of lawyers. When those shares are sold short, the accounts from which those were borrowed, those account owners, those account holders cannot any longer participate in company shareholder votes. They now no longer have shareholder voting rights because those shares have actually physically been sold from the account, legally been sold. There's simply a contingency where the short seller agrees to pay any dividends to that account. If that account holder decides to sell their shares that have already been sold short, then the short seller will actually have to cover that action. That's a short call. And that's, I think most people are aware of the short squeeze that can happen if too many investors are short too many shares of a company stock, and all of a sudden the market starts to bid up the price, or the rightful owners start to sell their shares. So do keep that in mind, not just for this class, for your own understanding. All right, I don't understand how over 100% of float can be short. So there's some answers in the chat. That's the really peculiar thing about this, these kinds of activities. So if a lot of different investors decide to short sell, and they short enough securities, and all of a sudden there are more people buying those shares, it actually can cause this really peculiar thing. So these shares are just essentially get passed from broker to broker to broker and being shorted by lots of different other people. Now, I don't know, short interest is a very peculiar thing. Let me actually pull up. They only report, and that's probably going to change going forward. It seems like it will eventually. They only report short interest twice a month, which is a problem. Now, whenever a large institutional investor does short shares, they actually, are issued essentially a transaction ID. The SEC knows it, so the SEC knows where all the short activity is and how many. So I do know that the short interest I'm presuming this is coming out of what happened with GameStop. I do know that short interest in terms of days to cover, which is based on the average volume of transactions, did get as high as 25. So in order to buy back the shares of all the short interest shares, it would take 25 days worth of average volume to work through all those short positions. But because the way that short selling works, if there are enough short sellers, they can actually just pass the same shorted securities throughout the marketplace. Now, I'm not 100% certain how high. I mean, it was reported to be 140% of the float. Right now, this would be as of, I believe, February 15th. It's 31% of the float in short interest. They probably got squeezed today. A little bit. But it's a really peculiar thing. I would venture that reporting requirements are going to increase to, if not daily, then perhaps weekly reporting of short interest. But it is something that goes on. The ones that are very good at it are usually ones that are looking to find companies that are not just poorly run, companies that are usually doing something against regulations or illegal. And I mentioned Jim Chanos a few weeks ago. He was one of the most famous short sellers of Enron in the late 90s. Enron was essentially doing things that I think were illegal. And he noticed that and said, oh, this is going to end poorly. So he shorted shares of Enron. Okay. What are the mechanics of short selling? So that's a great question. That's just unfortunately one that's difficult to answer without the benefit of having something to show you a little bit more clearly what goes on. Like an infographic or something. Let's talk about the mechanics of how a actual short sale would work. An investor posts about $50,000 in T-bills in their account. That's going to be used as collateral. It's very safe, very secure. It's held in custody by the broker, and then they borrow and sell $100,000 worth of stock, 1,000 shares. Now, this is where it gets tricky. What's the initial percent margin of the account? What happens if the stock price rises to $105? They have shorted the shares. They want the price to go down so they can buy them back. If it moves against them just 5%, what happens? At what stock price would the account holder be called to post more collateral with a 30% maintenance margin? Okay, let's answer the first couple of questions. Equity in the account over the value of the stock owed. This is a peculiar nuance. Their equity is $50,000. They owe $100,000. The value of the shares, 50%. They've levered up 2 to 1. It's a bit risky. Assets minus short position, the equity, 150 minus 100,000 divided by short position. That's how a short margin loan works. You want to make sure you have enough to cover. What happens if the stock price increases to 105? Well, you're going to take out these thousands to make the calculations a little bit simpler. So this becomes 150. This just becomes 150 minus P over P, 150 minus 105 over 105. 5% increase puts the margin at 42.86%. So what's the stock price that would drive it to a 30% maintenance margin? Well, you take that ratio, 150 minus 1,000 shares times the price, divided by 1,000 shares times the price. They're going to have to buy it back at that price. 30%, do the algebra, 115.38. A 15% increase puts the investor at risk of a margin call. How do we know it's 100 or 1,000 shares? Because it says shorts 100,000 shares worth of stock, and the stock is $100 per share. Divide $100,000 by 100, you get 1,000 shares. Sorry, I didn't put that explicitly on the slide. So, questions about short selling? Or margin? Most larger brokerage firms are retail brokerage firms and institutional investor brokerage firms are going to be very careful about extending margin to clients. It's in their own best interest. And also when clients use margin and they end up getting burned, some clients are more litigious. And whether or not it was the broker-dealer's fault, they don't want that blemish of being sued by a client.